certain type of security that I see people sell options with all the time that can be extremely dangerous. And so I'm going to talk about how it can be dangerous and a couple of other things you should know. So firstly, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. So let's get right into this video. I'm going to start by going over to ticker symbol SPY. This is the SPY ETF. So SPY is currently at $413 per share. In the last year, SPY is down about 1%. Okay, now let's go into the options here for SPY. And let's take a look how much we would make if we sold a put with SPY. So the first thing I'm going to do is I'm going to go out 3 weeks to May 20th. And then I'm going to go over to sell and I'm going to go over to put. So let's say I wanted to sell the at the money put right now 3 weeks out. So remember, the at the money option is going to be the option whose strike is as close to the current share price. So current share price is $413.40. Closest strike to that is going to be the $413 strike. So this is the at the money option. If I sold this put in 3 weeks, if this expired worthless, I would make $1,212. Now, I would have to put up quite a bit of collateral, right? $413,000. But after you do the math, you would see that if this does expire worthless, you would make about a 2.9% return. Now, some people don't like that return. They think that return is too low, or maybe they just don't have as much money to put up, $413,000 to be able to sell this put. And so what I see a lot of people do is they go to something like this right here. This is ticker symbol SPXL. And as you can see, it's called Daily S&P 500 Bull 3 times shares, which is currently at $90 per share. In the last year, this is down 9%. And so if we take a look at the premiums on these options, let's go over to the options here for SPXL. So we see that the first available expiration is May 20th. That's why it chose May 20th for SPY, so that we could compare these two. If I go over to sell and I go to put, and I also want to sell the at the money put option here. The at the money option here is going to be the $90 strike option because that's exactly where the share price is at right now. If I sold the at the money put option here, in 3 weeks, if this expired worthless, I could make about $800. And again, after you do the math, you will see that that would be about a 9% return in 3 weeks. That's a lot bigger than the SPY return we saw, which would be only 2.9%. So if you're making 9% every 3 weeks and you did that all year, that would end up being about a 156% return. Sounds really good, right? Well, there's a lot of risk here. So let's actually go back here to SPXL and let's first talk about what this is. What is SPXL? Well, let's just read the about here. So SPXL provides daily leveraged exposure to a market cap weighted index of 500 large cap in mid cap US companies selected by the S&P committee. So basically, it tracks the SPY, the S&P 500, and whatever it does, it's going to do 3 times as much. And this is the bull, meaning that if SPY goes up, this will go up 3 times as much. If SPY goes down, this will go down 3 times as much. And we can confirm this. If we go back to SPY here and we go back to the chart, SPY on Friday was down 3.7%. 3.7 times 3 is 11%. So we should expect SPXL to be down 11% on Friday, which it is, right? So that's basically what it does here. Now here is the mistake that some people make. People might think, or this obviously tracks the SPY, and people think, well, SPY always ends up going up in the long term, right? SPY is always green in the long term, might be 1 or 2 years, but the market has shown us the SPY, the overall market always recovers, SPY should always go up. And so this should be a safe investment, right? Because this will just do 3 times whatever SPY does. And so if SPY ends up being green long term, this should be green 3 times that of SPY. But that's not the case, okay? In fact, this is extremely risky, especially to use as something for like selling options. And let me first say that this should really only be used for day trading or for hedging. It should not be used for long-term investing or selling puts or selling covered calls, because it is not actually going to return 3 times the long-term average of the S&P 500. It will for the day, but long term, it's not going to give you 3 times. This gets reweighted every single day, which will affect your performance. And so let me show you what I mean, okay, by doing some simple math. So let me go over to my notes here, and let's take a look at what I'm talking about. So let's say, here's an example, that we have an index that's at $100. So let's say, for example, SPY, let's pretend SPY is at $100 right now instead of 413. And then we have our 3 times leveraged ETF, which is also at the same price. Let's say $100, right? So let's say SPXL is also at 100. So if we take a look at the index, right? Let's say that on the first day, it goes from $100 to $99. It drops 1%. And you can do the math. I'm not going to show you the math here, but if you do the math, you'll see that if it goes from 100 to 99, that means it dropped 1%. If the next day it goes from $99 back up to $100, you're going to see that it goes up 1.01%. And again, you can do the math here. Now, if we take a look at what the 3 time leveraged ETF would have done with that same stuff there, well, let's take a look at what the math tells us. So if if the index, right, the first day drops 1%, a 3 times leveraged ETF would go down 3 times as much, which would be 3%. So if we start at $100 and it drops 3%, it would go down to $97. Okay. The next day, the index, as we saw, went up 1.01%. 3 times that would be 3.03%. So again, if you do the math, if you're at $97 and you go up 3.03%, that's only going to get you to 99.93. And so take a look at what happened here. Even though our index, right after the second day, went back to exactly where it was starting the first day, in other words, it's flat, right? A lot of people would expect that something that's 3 times leverage that would also go back to being flat. But as you can see, that's not the case. It actually ended up losing. Even though the index would have been flat after 2 days, this actually would have been down from where it initially began. And so ultimately here, it's going to take longer and a lot of consecutive green days for you to break even on a 3 times leveraged ETF after huge drops. And we can actually see this if we take a look at how long it took SPY and SPXL to break even after the 2020 crash. So let's take a look here. So let's go back to Robinhood here, and let's go to SPY first here. So remember, in 2020, we had that big crash, right? Where SPY, as you can see, dropped from 337 down to about 228. So how long did it take to go back to that high of 337? Well, let's take a look here. If we take a look, it went back up to 337 around August, as you can see, right? In August, it was back to the high that it was before the crash, right? So in August, we're back to normal. What happened to SPXL? Well, let's take a look here. So SPXL, if we take a look, firstly, it dropped way more, right? It went from $75 to, $19, almost wiped out completely because, again, it dropped 3 times as much every day. But let's take a look. How long did this take for it to go back to $75, which is where it was at before the crash? Was it in August like SPY? Well, let's take a look. Well, in August, this was only at $60. And then it dipped more. And so let's continue here. Where did it hit $75 again? And you will see that it hit $75 not until January, right? So SPY went back up to breaking even in August. This didn't break even up until January. Why? Because it takes a lot longer for a 3 times leveraged ETF to break even. And it also takes a lot of consecutive green days, which fortunately we saw during that year, right? We had basically the biggest bull run we've ever seen. So many consecutive green days. If SPY had continued to dip and then go back up and dip and then go back up, this probably would still be down, in the $20, $30. People would still be down 50% or so from that high, right, before this thing crashed. So it can be very, very risky, guys. And in fact, if we take a look here, right, another thing to notice here, if we take a look, SPY right now is at 413. Before that big crash, it was at 337. So it's actually gone up 22. It's still up 22% from its high before that crash. It's up 22%. How much is this SPXL up before it crashed in 2020? Well, before it was at 75. Now it's at 90. It's actually up only 20%. Okay, so as you can see here, SPXL is up only 20% from its high before the drop. SPY is up 22% from its high before that drop. So as you can see, SPXL is not up 3 times that amount. It's not up, 66% like people would think. It's actually up 20%, which is less than SPY. So again, in a bear market, in a really red market, you can really hurt yourself, right? The premiums are very tempting, but that's because it comes with a lot of risk. It's very easy to lose 20, 30, 40, 50% on these 3 times leveraged ETFs, especially in a bear market, especially where there's so many red days, one after another. So 3 times leveraged ETFs are not meant for long-term investing. They're not meant to sell puts. They're not meant to sell covered calls. You can get lucky and make some great money off of them, but the risks honestly outweigh the reward. And so here's another example that I want to show you guys here before I end this video. So let's take it a little bit more further here. And let's say that we have 4 consecutive days where the market drops 10%, then it goes back up 10%, then it drops 10%, then it goes back up 10%. So again, with our index, right, think of this as being SPY here, and SPY starting at $100. If the first day it drops 10%, it would go from $100 to $90. The next day, if it rises 10%, it would go from $90 to $99. And again, you can do the math, okay, if you want, but this is what is going to happen. And then the next day, let's say it drops again 10%. Well, it would go from 99 to 89.1. And then finally, let's say on the 4th day, it goes back up 10%. You would go from 89.10 to 98.01. So overall, from where you started the first day, you would only be down 2%, which is not bad. But let's see what would happen to the 3 times leveraged ETF that's tracking this. So on the first day, since this dropped 10%, this would have to drop 3 times as much. So it would have to drop 30%. So it would go from $100 to $70. That's a 30% drop, right? Now, let's say the next day, it goes up 30%, right? Because over here, it went up 10%, so this needs to go up 3 times that, so it goes up 30%. It would go from $70 to $91. The third day, this dropped 10%. This would have to drop 3 times that, so 30%. That would go from $91 to $63.70. Finally, on the 4th day, since this went up 10%, this has to go up 3 times as much, so it has to go up 30%. It would go from $63.70 to $82.81. So at the end of the 4th day, even though our index would only be down overall less than 2%, this 3 times leveraged ETF would be down 17.2%. And as you can see, that's a lot more than 3 times the loss with the index, right? That's not, that would be 6%. But no, it's down 17.2%, okay? So don't get this confused, guys. In the long term, it's not going to be 3 times the return of the index. As you can see, if you get a lot of red days, it's going to be way, way higher than that with this example here. So anyways, be very careful when it comes to these 3 times leveraged ETFs. It's very easy to lose a lot of your money using them. And again, they're not meant for long-term investing. They're not meant to sell puts, sell covered calls every single week on, because again, they can wipe you out very, very easily. So anyways, if you have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.